Hello, welcome to a demonstration on how you can calculate and read and translate key financial ratios in liquidity. Liquidity ratios are some of the tools and techniques that can be used to convert financial statement data into formulas that can be used to evaluate the firm's financial condition and performance. Now, both can be calculated over time or in comparison to industry competitors or industry data. So the tools and techniques include important financial ratios that can give an idea as to the solvency of the organization, at least in the short term. So in other words, the main focus here is to understand how well the organization is placed in terms of being able to fulfill its immediate financial obligations, right? Being able to pay its bills. Now, what you'll notice in this particular demonstration is that I do show you the actual formulas and where I specify which line items you should actually pick and where those will be from. So some are from financial income statement, and some are from the balance sheet, and again I'll be able to highlight those ones here. So if you follow through, you'll find that you'll be able to actually find the information identifiable, right? For example, total current assets, current liabilities. If you go to your balance sheet, you'll be able to find those lines, right? And those are the numbers that are actually being used here. Now, in my case here, for this particular demonstration, I've got a balance sheet on the side, and I'm actually picking those numbers from there, right? And again, I expect that that's how you do the same thing. You need to have your balance sheet, you need to have your income statement, and in some cases, some of the numbers could as well be coming from a cash flow statement, right? So I'm assuming that you've got some working knowledge of financial statements in general, and that some of these terms will actually come across as familiar, right? So again, we'll kind of just walk through and interpret those numbers, what they actually mean, those financial ratios. And again, just remember that this is for liquidity ratios. We're just focusing on the liquidity, right? The short-term solvency of the organization. In other words, the organization's ability to be able to fulfill its financial obligations, at least in the short term, right? There are also other long-term solvency financial ratios where you can actually measure whether the organization will be able to survive in the long term. You can actually begin to see some red flags if they exist in any. Is the organization over borrowed? Do they have any leverage to borrow more money in case of crisis and things like that? But again, that's a topic for another day. So let's just focus in on the liquidity ratio here, right? So the first one is called the current ratio. All you're doing, you're just expressing current assets over current liabilities. So in other words, all those short-term assets that you actually own expressed over the current liabilities. And the answers that you get in this particular case, we've got 2023 and 2024, right? It's actually telling us that there's been actually a slight decline. In other words, for every dollar of current liabilities that this particular organization owe, they've got $2.40 for each dollar. So which means they've got more than enough for them to be able to fulfill their short-term financial obligations. So if their creditors were to come by and say, well, we want our money now, they've got enough current assets. They're holding enough current assets that enable them to be able to pay off, right? But now there's also an argument that the current ratio can be an illusion, or in other words, the current assets are always overstated, because their understanding here is that when we talk about current assets, we're talking about assets that we can easily convert into cash, right? But now it so happens that inventory is included in total current assets. Inventory is not something that can convert into cash overnight, right? Because it's actually inventory that's sitting in your warehouse or on your shop floor. You cannot just sell it overnight so that you can use the money, right? So because of that, we have what we call the quick or acid test ratio, where we exclude the inventory. So in other words, we want to really emphasize on really being truly liquid, right? So we say, okay, inventory can give us a bit of a problem. We need more lead time in order for us to get rid of inventory so that we can convert it into cash. So what if we exclude that? You find that the picture completely changes, because this particular organization is pretty heavy on inventory. It carries a lot of inventory. That's the nature of the business, right? So here we can see that we only have, for every current liability that we owe, we only have 68 cents, right? We've got 68 cents available in our current assets when we exclude inventory. So it it got worse between 2023 and 2024 for this company, at least. The prior year, it was about 95 cents. It was almost 1-to-1, right? So it further declined, right? So that's very, very important to understand the difference between current ratio and the quick or acid test ratio, right? We are trying to be as realistic as we can be. What about if we go further and say, okay, what about if we just look at the cash, the real cash itself, right? Including the cash that we actually generate in an organization, just strictly cash or cash equivalent, that is marketable securities, the money that we know we can easily convert at least overnight. Here, when we actually do that, we see that we are around 70 cents this year. It's about the same, about 70 cents per every dollar that we owe to our creditors, right? So in a way, you would say, well, we're trying to test different ways to figure out how liquid we really are in terms of cash. What about if we exclude inventory, right? So we're trying to be as realistic as we can be. But now, usually you find that when you are evaluating financial ratios, you do not just evaluate them in isolation. That's why I did emphasize at the beginning that we are just focusing on liquidity ratios. There are other categories of financial ratios: activity, how active are we in our operations, how efficient are we in our operations, and what about on the market, right? How is the market responding to our organization and so forth? There are a variety of financial ratios out there such available. But even within the category of liquidity ratios, while we understand where we are right now, we also want to measure how efficient we are in collecting money from our debtors, those who owe us money, right? In this particular example, you can see that this particular organization in 2023, it was taking them on average 20 days to collect money, right? And they improved by 5 days in 2024, which is actually good, which means they're able to collect the money quicker, which means money can become cash a lot quicker, so the turnaround is much, much better. But you always want to compare that with also how long are they taking to pay their creditors. In other words, what are the terms they are negotiating? Because you always want to make sure that you negotiate longer terms with your creditors so that they give you more time to pay. And of course, on average, you always want to make sure that the average collection period, the time you have to collect money from your debtors, is shorter than the time you need to actually pay your creditors. So you always want to make sure that there's actually a balance. In this particular case, you can see that in 2024, average collection period is 15, and they actually expanded their payables range to about 40 days. So they've got plenty of time to collect the money so that the money is available before they can actually pay their creditors, right? And of course, these numbers here, they should not be, they should not reflect an organization defaulting on their payments to their creditors. They simply reflect the organization actually negotiating good terms for themselves, right? So in addition to that, we also have the daily inventory, how quickly they are turning over the inventory, right? As we noticed up there, when we calculating the asset test ratio, we noticed that the inventory is really having quite an impact. But whatever impact it's actually having is also dependent on how quickly they are turning over that inventory that they're actually carrying. So they'll be carrying a lot of inventory, but then how they are turning it over so that it becomes cash again, right, is very, very critical. And so this, on average, it assumes that given a scenario, a hypothetical scenario, you order all your inventory, how many times are you able to clear the entire warehouse and then order some more? We know that in practice it doesn't quite happen that way, but on average, when we're using averages, that's basically what we're saying here, that whatever inventory they are carrying, they are able to clear all of it in 133 days, so which means they're able to clear it several times a year, right? And that's actually a good number, and this was actually an improvement based on these hypothetical numbers. It's an improvement of 13 days from the prior year, right? So it's very important to kind of look at the various financial ratios together, then that way they can begin to paint a picture that is a little more meaningful. So finally, the cash conversion cycle. So in other words, when you combine all these activities, the average collection period and a day's inventory, how long is it taking this particular organization to complete that cycle, to convert all these activities back into cash, right? How often are these recycling the process so that they can actually get the cash, right? And in this particular case, it's a combination of financial ratios. We have the average collection period, how long it's actually taking them to collect the money, and how long it's actually taking them to turn over their inventory, and how long it's actually taking them on average to pay their creditors. And that, when you add the first two and then subtract the days payable outstanding, you can see that this particular organization has improved drastically from 135 days the prior year to 107 days, right? Which is also consistent with the days inventory held as well. Days inventory held, right? Inventory turnover improved, and so did the average collection period. That's where the gains are primarily coming from. And of course, days payable outstanding also, it's actually an improvement when they were actually able to increase the term, so they bought themselves more time to actually pay their creditors, so they have more time to play around with their cash before they can actually fulfill their financial obligations. So there you have it. Liquidity ratios, very, very critical for every organization. Organization needs to understand how liquid they are. Do they have enough liquidity or enough funds that's actually available to fulfill their financial obligations? And the adequacy of liquidity is very, very critical for the survival of an organization. At least they're able to run their operations right away. They're carrying enough assets to cover their liabilities in the short term, and they are also demonstrating how efficient they are. So, and of course, taking all the necessary precautions. What if we exclude, inventory, which can as well be an illusion as a current asset because it's very difficult to convert into cash, right? So testing liquidity from different perspectives is the best way for an organization to be sure that they are in a safe place. Otherwise, that's all I have for you. I hope you find this interpretation of liquidity ratios within the context of financial ratios insightful, and hopefully help you build a very strong foundation in understanding financial statements interpretation. That's all I have for you. Thank you so much for watching. And again, if you like the video, like it, share the video, and be sure to subscribe to the channel. Thank you so much, and bye for now.